Welcome to our LLIS Insurance Academy Lite. Some of you may know that LLIS hosts our 2 days of in-person education Insurance Academy steps from Clearwater Beach, Florida in February. But due to the global pandemic, we decided it would be safe to hold off this year. Instead, we're planning 4 afternoons of insurance-related presentations. This presentation will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Questions will be answered at the end of the presentation. To receive a PDF copy of this presentation, you can download the file under Handouts. Participating in our second afternoon of Academy Lite, comes to us from the Principal Financial Group. He joined Principal in 1997. In 2015, he moved to Florida and took over the Florida and Alabama territory. Here to speak to us on what you need to know about disability insurance and its underwriting is Bob Herman.
Thank you, Claudia. Nice to be here this afternoon. In regards to our topic today, what you need to know about disability insurance and its underwriting, there's two primary goals that I hope we all take away from this meeting in our 50 minutes together. Number one, understanding the importance of income protection with our clients. And two, it's incumbent upon us to bring this topic to our customers, or I should say our clients, in our conversations with them in the planning process. A little overview in regards to the agenda, some of the things I want to address today. Kind of start with the basic, what is disability insurance? Who needs disability insurance? What types of clients I think would benefit from this type of coverage? And then 4 common things that I think our clients want to know about income protection. I've been doing this a long time, and these are some common themes that I hear from our customers. Also talk a little bit about group disability benefits that some of our clients have access to, and then why we, in some cases, may supplement within their own individual policy. Also, I think it's important that we address the foundation of disability insurance, and I think the foundation starts with the contracts themselves, the types that are available, along with the different types of claims that our clients can potentially see. I think if we have that foundation built, it's a lot easier to answer questions and, more importantly, develop the confidence to have these conversations with our clients. The last thing that I want to address too is the underwriting process. We look at 3 different areas. First, from an occupational standpoint, some of the things that we pay attention to, and then followed by medical and financial underwriting. As far as disability insurance is concerned, it is the foundation of the planning process for all of our clients, is their ability to, I should say, is their ability to get up each and every day and make a living. We take for granted our health each and every day, and we assume that we can get up and go about, do our job, and meet our obligations that we're faced with. And I think for the most part, our clients pay attention to, protecting some of these things in regards to the financial planning process. In the event they live too long, die too soon, or become sick or hurt somewhere along the way. I think the first two, most of our clients do a pretty good job. They pay attention to, I got to make sure I've got some retirement plans set up, save appropriately, am I saving enough, and am I putting in the right investments? And then, obviously, if in the event I die too soon somewhere along the way, making sure our loved ones are taken care of. We also do a pretty good job of protecting our home, our automobiles, and other properties with other property and casualty types of insurance. But I would gather to say the probably most important thing in this planning process is protecting our ability to get up each and every day and go to work. It makes everything else in our world go around. If you think about it, our ability to earn an income, it allows us the house that we live in, the car that we drive, the retirement we hope to achieve. So it's probably the most important thing on this list in regards to protecting. What is disability insurance? Again, in its simplest form, it provides monthly benefits so we can meet our obligations in the event that we become sick or hurt. I think for many clients, they just need, they don't get provided the opportunity, I would say, to implement some of these plans. So again, that's why I mentioned earlier, it's incumbent upon us to bring this topic to the table. As far as who needs disability insurance, I think you could start with, anybody between the age of 25 and 55 that goes to work each and every day is a potential client in regards to protecting their income. I always refer to those folks in their accumulation phase of their life. We're accumulating, whether it's to hit our goals for retirement, college education, saving for a home. We just don't have enough assets at this point in time. If something were to happen, that we could live off of those assets. So that how do you say, client of who's a potential customer is those really between the age of 25 and 55. I always say the easiest way to get into this topic too with our clients is ask them three simple questions. Number one, why did you go to work today? I think ultimately, we're going to hear, after some goofing around a little bit, why did you go to work today? We're all going to get to the same end. Is I go to work, Bob, because I need the money. I got obligations that I got to meet, kids that got to get to school, mortgage payment I got to make. I need the money. Great. Now, second question is, what would happen if you became sick or hurt yesterday and you couldn't work for the next 6 months or the next year? What impact would that have on your lifestyle? Wait for the response. And then the third question is, tell me a little bit about the benefits or the assets that you could rely on so that you could meet the obligations that you're faced with. So it's a fairly simple conversation that we like to have with our clients. As far as the four things that our clients want to know about income protection or disability insurance, I think it boils down to how much can I get, when does it start, how long does it last, and most importantly, how much does it cost? If it was free, I don't think it would be an issue for most folks. They'd all sign up for it, right? So I'm going to address each one of these issues. So just bear with me a little bit in regards to this slide. I think it's important that we share a little bit of tidbits on each one of these topics. First of all, in regards to how much benefit I can get. Disability insurance is provided, or the idea behind it is we're protecting somebody's income so they could meet their obligations. We don't protect 100% of somebody's income, just simply from the standpoint that we still want that client motivated to go back to work. But as far as a maximum benefit is concerned, we can protect, as a good rule of thumb, about 60% of somebody's income. Now, just understand that that's not a hard and fast rule. As an example, somebody that makes $30,000 a year, the industry would protect probably closer to 75% of that income. We understand that somebody that's making $30,000 a year is probably living paycheck to paycheck, and they need every bit of that protection. Whereas if I look at somebody that's making $300,000 a year, we would probably protect closer to 50% of their income. And the reason for that is, again, we want that client motivated to go back to work. We're interested in protecting the necessities of life, not necessarily the luxuries of life. And again, we want them motivated to go back to work. One other little tidbit in regards to the disability benefits, though, as far as taxability of that benefit, most of our clients purchase individual contracts and pay for this stuff with after-tax dollars. So in the event they were to become sick or hurt, these benefits would be received tax-free. And we'll get into a little later in regards to group benefits, but if we do in fact have employers in some instances or some owners of businesses, they have the ability to purchase plans and deduct premiums. In those cases, those benefits would be received and they would be taxable to the client. So there is a clear distinction between who's paying for that, and we'll get into a little bit later that why we want to ask those questions in regards to group insurance. As far as when does the benefit begin, if any of our clients were to say, or if you were to ask your clients, if you became sick or hurt yesterday, when would you like to see this benefit start? I'll guarantee you most people would say tomorrow. The problem with that is it can be pretty expensive, right? It's like a health insurance plan with no deductible. So our elimination period is our deductible. It's days instead of dollars. Typical elimination period in the white collar professional marketplace is a 90-day elimination period. Again, our client is self-insuring for the first 90 days. They begin to accrue the benefit on the 91st day, and we pay that benefit on the 120th day. It's good to make sure our clients understand that they will receive that benefit basically 1/3 of the way through the year, so 120th day. And also in regards to elimination periods too, it depends on the marketplaces. You'll find some of the blue collar, they're going to want those benefits sooner. So you might see a 30-day elimination period with more in that marketplace. How long does the benefit last? 2 years, 5 years, 65, 67? Some of those are some of the options that are available. Two little tidbits in regards to the benefit periods. Again, in regards to white collar marketplace, typically we're showing a 2 age 65 benefit period. Don't be afraid of a 2 or a 5 year benefit period because again, they're per incident, the benefit periods. It's not an aggregate benefit. So as an example, if I had a 2-year benefit and I had developed some back problem and the principal started paying me and I received benefits for 20 months, and all of a sudden I've gotten better, I go back to work. As long as I'm back to work for a period of 6 months full time, that clock starts all over again. I get a brand new 2 years. The only thing is I've got to satisfy elimination periods again if in fact I have another occurrence that takes place. So just keep that in mind in regards to the benefit periods. And again, all three of these have an impact on the premium. And you'll notice as we go through this too, what we're trying to do is give our clients options and choices. I think most importantly, we want to put our client in a better spot today than they were yesterday. So if it means buying something or taking advantage of something that's affordable today, that's what we want to do, is get them something. A meaningful benefit. If all I can afford is $1,000 a month, that's great. Because if I ever became sick or hurt and somebody's sending me a check for $1,000 a month, you're darn tootin' I'm going to cash that check each and every month. So it is a meaningful benefit for our clients. Common objections that we hear, that I often hear in regards to income protection. I'm going to go through these real quick and then I'm going to share with you a couple of slides in regards to these topics. But the first one, it's never going to happen to me, Bob. No, sirree, never going to happen to me. It costs too much. And the third one is I have something already. I'm good. I got something through my employer. I've got a plan already in place. So I'm going to review some of those objections and maybe how we handle some of them. First of all, that's probably the biggest one is it's never going to happen to me. I'm sure there's many people on this phone call today that aren't standing in line to become sick or hurt. That's not something that nobody is planning for. And speaking of that, disabilities happen tomorrow, and the question is, are you ready? For most people, it's not something like we say, okay, next June 15th, I'm going to develop an illness and I'll take care of it then. It happens tomorrow, and the question is, are we ready? Just an interesting fact in regards to Principal, the company that I work for, in 2019, Principal paid over $400 million in disability benefits to our clients. Again, $400 million, that's one company in 1 year. So we do know it takes place. And again, in regards to most of the claims that we see, this particular slide, everybody thinks it's going to be an accident that takes them out. That, if I become sick or hurt, it's because I'm in a car accident or I fall off the roof because I'm getting leaves out of the gutter. That's not the case. Over 90% of our claims are due to an illness. And so those injuries are a small part of the reasons we pay claims. The other objection that we hear is it costs too much. Everybody can afford an individual disability plan. You can, as we talked about just a couple slides ago, tailor a program to make it affordable for anybody. So there are options to make it affordable, but just in regards to income protection itself, as a general rule of thumb, it would take about 2 to 3% of your income in regards to maximum benefits with a pretty strong contract with all the bells and whistles. So if I'm making $100,000 a year, 60% of my income is $5,000 a month. That contract would probably cost somewhere around $1,500 to $2,000 a year, depending on occupational age, and we'll get into some of that a little later. But I think it's important also to pay attention to what's the cost of not doing it. I remember years ago reading an article about how anybody can be a 401k millionaire. There was only three things you needed to do to become a 401k millionaire. Number one, start early. Number two, be consistent. And number three, don't touch it. Let me repeat that last one. Don't touch it. Unfortunately, sometimes our clients may not be in a position to avoid that one. And what ends up happening is if in fact any of our clients were to become sick or hurt for a period of time and they don't have a plan in place, unfortunately, they still got these obligations they've got to contend with, and they still got to pay these bills. So they go to the only place that they've saved money. And for most people, it's those long-term vehicles. It's a 401k, an IRA, a SAP plan, or something along that line. And if I take a 35-year-old who's been saving for a little while, right, and yet now he's 40 years of age and something were to happen, you're talking about taxes or penalties on that, taxes, and the most important thing is losing the compounding of interest of that debt. So over the long haul, that could have a devastating impact, right, at 65 years of age, having to dip into any of those long-term vehicles. So again, from a cost standpoint, it's all relative. We can all find something that's affordable. And there's so many other things in our lives that are so important that we keep in place, right? We got to make sure we have a cell phone, and we got to make sure we have internet service and a cable TV. But we got to make sure that we also protect our income, because it's what makes the world go round. The next objection, or the third objection that I commonly hear is, Bob, I've got something through my employer. I'm good. I've got some disability benefits already. And typically when I hear that, my response is always the same. That's great. Not a lot of people have access to benefits like this through their employer, so that's terrific. But one of the things that we want to do as advisors is take the time to make sure we understand, or more importantly, our clients understand how those benefits work. So this is an opportunity to establish credibility with your client and show that you care, I always say. So one of the things that I like to do when somebody says they have group insurance is say, hey, listen, I'd like to take a look at that summary plan description that you have. It's easy today to get access to this for most of the employees today because it's online. You pull up the document, and there's 6 pieces of information that we want to pull from that document. And they're fairly easy to find. How much did I get? When does it start? How long does it last? Are the first 3. Okay, sound familiar from earlier. Those are the first 3. The next 3 things we want to know is who pays for this coverage? Does the employer provide it, or does the employee pay the premium? The 5th thing is, what's the cap on that group insurance plan? So all group plans have an ultimate cap. They say we'll cover you for 60% of your income up to a certain dollar amount. Maybe it's $5,000 a month, maybe it's $10,000 a month, but we need to identify that number. And the last thing is, how does that plan define earnings? Because you mentioned 60% of my earnings. What is it? How do they define earnings? Is it base salary? Does it include my incentive compensation or bonuses? So we want to find that out. And once we have that information, now we want to go back to the client and explain to them how it works. Because our clients understand when they have benefits, they remember pieces of it, right? I get 60% of my income, Bob, this is great. But I want to go back and explain it to them. So here's an example. We've got somebody making $75,000 a year prior to taxes. That's $6,250 a month that they're bringing home. After taxes, healthy and working, they're going to receive or net about $4,375 a month that they use to pay all of their bills: mortgage, utilities, groceries, you name it, kids, sporting events. Now, in the event that this client were to become sick or hurt, they get 60% of their income, which is terrific. 60% of that $6,250 is $3,750 a month, which is a meaningful benefit. Now, a lot of our clients don't understand that they have to pay taxes because we're asking that question. One of those was, who pays for this? In this case, we find out the employer is providing it, so the employee has to pay taxes. So it's not $3,750 a month that they're going to see. And I just keep it consistent in regards to the tax bracket. They're going to see closer to $2,600 a month. Boy, that's a far cry from what I thought I was getting. And so this is just an example of why some of our clients supplement their group plans with an individual policy. In this particular case, the client is eligible for another $1,600 a month that goes on top of their group benefit. That $1,600 is tax-free. So that 68% of income gets them a lot closer to what their net take-home pay was. Now, again, summarizing why they supplement their group insurance. Number one, I didn't realize, Bob, I had to pay taxes on this stuff. It's better to understand this before something happens than after the fact. After the fact, we can't do anything about it. The second thing is we refer to reverse discrimination. What happens if we have a client that's making $200,000 a year and they have a group plan that says we'll give you 60% of your income up to $5,000 a month? Well, they're not going to get their 60% on that income, right? It's because of the cap. So we refer to that as reverse discrimination for the highly compensated folks. And again, they may just be eligible for a larger individual piece that goes on top. Better to understand that when we don't need it. Another area is incentive compensation. Is it covered? In some cases, you're going to find, or I should say in a lot of cases, our group coverages are only going to cover base salary. So bonuses and things that incentive compensation may not be covered. And if that's the fact, we can cover that total income with an individual contract. But the biggest reason, again, that our clients supplement their group plan is the portability factor. In this particular case, we have got a client that purchases a plan for $1,600 a month. It's a meaningful benefit. You know, I always say it's hard enough to live on 100% of your income. Try living on half of it. But in this particular case, we can still get a little bit more coverage or replacing of our income. But now I have the ability to take this policy with me. What happens to Joe here if he ends up leaving the company? He doesn't take this group insurance plan with him. It's gone. And now there might be an opportunity that he can go out and buy his own individual policy, but we got to make sure or hope that Joe's still healthy too. And we're going to get into some of the medical and financial underwriting that we're faced with. So in this, one of the reasons why we like to sell these policies on top of the group insurance is because we're trying to not only protect income for our clients, that's one aspect of it, but we're also trying to protect their insurability. And if we can arm wrestle one time with an underwriter and be done with it. So once this client has a policy for $1,600 a month, now if they ever lose their group insurance, there's options on these policies that allow them to increase their benefits in the future without ever having to go through medical underwriting again. So he leaves for an opportunity, this particular individual, to go to a company with some equity interest or more growth opportunity, whatever it might be. And he gets to the new employer and they don't have group disability benefits. He can take that $1,600 a month and ratchet it up to whatever he qualifies for financially. And let's say his health changed. Now he's faced with some, high blood pressure, his height and weight got out of line. It doesn't matter. He still has the ability to ratchet that benefit up. Standard rates though. One last important point in regards to why our clients supplement group insurance. Sometimes there's hidden expenses that we're faced with if we're ever faced with an illness or an injury. And if you think about it, if I were to become sick or hurt at principal at 6 months, I would be, and I'm out of work because of this illness, I become an ex-employee. I may now have to pay for my health insurance on my own with COBRA premiums. I wasn't anticipating that. And we all know those COBRA premiums aren't cheap. The last thing I want to lose is my health insurance if I'm sick or hurt, right? So if you think about it, I go from down to $2,600 a month and now I got to pay my health insurance premiums. Maybe something I wasn't anticipating. So sometimes there's hidden expenses that we're not aware of, a reason why we still want to supplement our group coverage. I'd like to spend a little bit of time now in regards to the foundation of disability insurance. I think it's important that if we understand some of the basics behind this stuff, it allows us to have more confidence in our conversation with our clients. It gives us a better understanding of how this works, allows us to answer simple questions that many of our clients will have. Now, I would tell you that we don't have to explain this to a client. Believe me, that's not the case. That's only for this audience itself, or to educate ourselves in regards to these contracts. And again, it allows us to develop more conviction of why it's important to own. So there's three types of individual contracts, or three types of contracts that we see that are sold with disability insurance: non-cancelable and guaranteed renewable, and conditionally renewable. I'm going to start with that first one in the top right-hand corner, that guaranteed renewable contract. Guaranteed renewable says that when I purchase that policy from the carrier, once I start paying the premium, I have the right to renew that policy all the way to the age of 65. Regardless of changes in my health, my job, or my income, I have the right to renew the policy all the way to the age of 65. The carrier can't change the product or take it away from me. However, under a guaranteed renewable contract, that carrier does reserve the right to change the premiums if their loss ratios are greater than they had expected. And again, that's the only reason. Loss ratios greater than they expected. If they say our investments aren't performing as well at our company, no, sorry, Charlie. If our operating expenses are out of line, too bad. The only reason I could change these rates, and again, we can't pick on an individual, it's typically for a class, an occupation class, for a particular state, and they've got to show loss ratios higher than they're expected. Okay. The other box to the left there, non-cancelable guaranteed renewable, is another type of contract that's sold. And the difference between the two, obviously, is just that non-cancelable piece, but again, it says the same thing, guaranteed renewable. Once I purchase that plan, I have the right to renew the policy all the way to the age of 65, as long as I pay my premium, and the carrier can never change it or take it away. I control the policy. But on this particular contract, the premiums are guaranteed to the age of 65 versus the guaranteed renewable. Now, if you can imagine, if you've got one contract that has a guaranteed rate and another one that can come back and ask for more if they ever run into trouble, the reserve requirement that's needed on a non-can or a level premium is going to be a little higher. So those premiums are going to be higher than they would on a guaranteed renewable contract. I'm not here to tell you which one's better or worse. That's not the point. It's to understand there's a difference between the two, and that's one of the differences you'll see as far as rates are concerned. Now, I would tell you that in most instances, what we find is the marketplace kind of drives which contract you go to. Guaranteed renewables, a lot of them are sold in the blue-collar market space. In the non-can product, a lot of the white-collar purchases those types of plans. I always say the easiest way to determine which contract your client should have is just simply ask them when they shower. If they shower before work, they're a non-can client. If they shower after work, they're a guaranteed renewable contract. Now, both of these contracts I kept referring to is the benefits, or the contracts are renewable to the age of 65. That's typical. What happens at 65 then? Is the coverage gone? Well, most contracts are going to have the ability to conditionally renew the policy beyond age 65. Conditionally renewable says that I can renew the policy on the condition that I'm still working full-time. And we recognize full-time as 30 hours a week. One other thing in regards to the conditionally renewable contracts is those premiums aren't guaranteed anymore, so they're going to start to increase each and every year. They start to look like term insurance rates. They kind of go up. Now, we hope with proper planning that our clients don't need this coverage at 65 years of age. They've got enough assets that they can fall back on, and they don't have the need for protecting their income. But we do have quite a few clients that continue to hold their coverage. Either they haven't saved enough, or they're still working, got obligations they got to contend with. So it is available. One thing I'd like to use it's kind of an extreme example, but it makes its point in regards to these contracts. And again, this is the value of an individual disability contract. The most important thing is this non-can guaranteed renewal feature. The example goes like this. I've got a corporate executive that works here in the Tampa. Now, let's say a young attorney that works here in the Tampa area. And the attorney is 35 years of age. And he's making $250,000 a year, and he purchases a policy for $10,000 a month. At the age of 45, 10 years goes by. He's been paying his premium all along. He decides, you know what, I really don't like being an attorney anymore. I can't stand working with these clients. They're driving me crazy. I've always enjoyed fishing. I want to start my own charter fishing boat company. I go out and buy a boat, and I decide I'm going to start doing charter fishing trips. Well, do we change when that client changes their occupation from an attorney to a commercial fisherman? Do we change his rates? Again, what we just talked about, non-cancelable, guaranteed renewal, no, can't change it regardless of the changes in the guy's health, job, or income. Wait a second, this guy, when he purchased the policy, he was making $250,000 a year. He bought a policy for $10,000 a month. Now he's a commercial fisherman. He's only making 30 grand his first year out. And he develops an illness. He files a claim with the carrier, with principal. Says, hey, listen, I've developed this illness. I've got this policy. We simply ask, can you perform the substantial material duties of your occupation? And it's what your occupation is at the time of claim. Can you perform the duties of a commercial fisherman? Nope. His doctor says no. So we're obligated to pay $10,000 a month, 120 grand a year, even though that guy's only making $30,000 a year. That's the strength of that individual policy. Again, you're not going to find that type of strength in a group contract or an association plan or anything along that line. But again, keep in mind, the client controls that policy. It's an extreme example of a case, I get it, but they have options too. You know, that client, when he moves to a commercial fisherman, he can keep the same policy, but maybe lower the benefit if he wanted. He has that option available. Now, in regards to the contract itself, it's good to understand that, the value of that policy. Now, in regards to the types of claims, I think it's important to address the 4 types of claims our clients can potentially see. I'm going to start with the total residual recovery and what happens if I can't do my job and go into a new field. Those are the 4 claims. I'm going to start at the top with total disability, and I'm going to use as an example, I've got a young dentist. He's 35 years of age, making $120,000 a year. And he purchases a plan for $6,000 a month, okay? Typical 90-day to 65 plan. Now, let's just say 10 years goes by. The dentist purchased the plan at 35. At the age of 45, the dentist develops an illness, and he files for a claim. In that process, we communicate with the dentist's personal physician and ask, can the dentist perform the substantial material duties of his occupation? If that personal physician comes back and says, no, he can't, he's going to be out a while, this guy's faced with this, this, or that, great. We start, once that client satisfied the elimination period, we start paying him $6,000 a month, and we'll continue to do that as long as the client's disabled. It's a fairly easy one to explain. The next type of claim is a residual claim. And for many of our clients, these next 2, no, they didn't even really know this was part of the deal, but you may not be totally disabled. You don't have to be totally disabled in order to collect a benefit. And a residual benefit simply says that if a client has a restriction in their ability to perform their job and they suffer a loss of income of 20%, they're eligible for a benefit based on that loss of income. So again, my dentist at the age of 45, instead of the illness, let's say he developed a back problem. And at the age of 45, 10 years later, he bought the policy, he was making 120 grand. Now he's making $240,000 or $20,000 a month. That's his income now. So at the time of claim, again, we're going to ask his personal physician, tell us a little bit about what's going on. This guy's got this back problem. He can't stay on his feet as long. He's got to, take some breaks throughout the day. In that case, his patient load may go from 20 patients that he was typically seeing, healthy and working, down to 10 because he's got this impact of his back is having some repercussions. And let's just say his income went from 240,000 down to 120. In its simplest form, he's got a 50% loss of income. He'd be eligible for 50% of his benefit. Okay? That's how a residual benefit works. The next type of claim is a recovery claim. Recovery says, I've had either a total claim or a residual claim, and now my doctor says I'm healthy as a horse. Bob, you can go back to work. Go back 100% what you were doing. And let's take our dentist now at 45 years of age. He's been out of work for a year. He's totally disabled. He's been out for a year. And his clients have gone somewhere else, right? Their teeth still hurt. They got to get them still worked on. So they've gone down the street to another dentist. It may take that dentist a while to build his income back up to 240,000. In a recovery aspect, we would continue to pay a benefit as long as there's a loss of income of at least 20%. Okay, so again, they're working full time, but they still suffer a loss of income coming back from either a total or a residual claim. Those are the three primary claims that we see. The last one is, what happens if I can't do my job as a dentist anymore and I decide to go into a new field? What happens to my benefit? And this is where we argue and fight all the time in our business about my contract's better than your contract. I'm going to use as an example two definitions of disability: a your occupation definition, or some refer to it as modified ONOC, versus an own occupation definition. Okay. Again, our dentist at the age of 45 is totally disabled. His doctor says you can no longer perform those duties. So let's just say the dentist has been collecting benefits, $6,000 a month for 5 years. At the age of 50, the client says, you know what? I'm tired of being at home every day. I'm going to go out. I'm pretty good on a computer. I'm going to go get myself a new job, start a new career. I can't be a dentist anymore. So he starts programming, and they start paying him, let's say $5,000 or $10,000 a month. Let's keep it simple, $10,000 a month. Under the your occupation definition contract, the definition says that if you can't perform the substantial material duties of your benefit, you get the benefit. They ask one other question though. Are you working anywhere else? Well, yeah, I took this job as a computer programmer. How much are you making? I'm making 10 grand a month. You were making 20, so you got a residual claim still, 50% loss of income, you still get 50% of your benefit. That's the base definition or modified ONOC. Now, own occupation is the strongest contract you can get on the street, most liberal definition. And it simply says, if I can't perform substantial material duties of my job, I get the benefit. That's it, period. End of question. So in that particular case, they don't care if the dentist goes into another occupation. They're still going to pay the $6,000 a month, even if he develops Google too, and this guy's making 200 grand a month. Doesn't matter. He's still going to collect his full $6,000 a month. Now, in regards to the difference between those contracts, it's about a 20% difference in cost of having ONOC versus the base definition. I would tell you this, to summarize this mess that I put on the screen here. Total residual recovery are the primary claims that we see in our business. They represent probably 95% of claims, if not more. And whether you have your occupation or own occupation, they're all paid the same exact way. The only difference between these two contracts is if we have a client that can't do their job anymore and they go into a new field, what impact does it have? And one set, as we learned, it becomes a residual claim, and the other one doesn't care. And again, own occupation, we typically, and this is the benefit of working with Lolo, these guys know the marketplace, they know what contracts your client should own. Own occupation is designed more in the professional marketplace. You see a lot in the medical marketplace with dentists, with attorneys, things of that nature, even some of our corporate executives. I know that's a lot there, but again, it's good information to understand in regards to how these claims are paid. In regards to information we need to quote a case, some of it's fairly easy, the name, date of birth, and the gender of the client. Real quickly, in regards to the gender, it is important from a pricing standpoint, male, female. Just so you understand, disability insurance, we have sex distinct rates. So females pay a lot more for disability insurance than men. We find as an industry, between the age of 25 and 45, women are almost 2.5 times more likely to be disabled during those age groups. And then after age 45, they tend to be pretty consistent between the two. And maybe an example of that might be prostate cancer for men versus breast cancer for women. It may take for men a little longer to develop the prostate cancer, and it occurs later in life, whereas female, they could experience breast cancer, in their 30s. So we do see the female rates a little higher. Some would say it's because of pregnancy or childbearing years or something along that line, but that's a piece of it, but that's certainly not all of it. not only breast cancer, but also MS, mental and nervous issues, rheumatoid arthritis. Those are some other examples that we see a little more in the female space. State of residence is important with our clients too, because there are differences in contracts by state, and some of the rates may run different too. As an example, California versus some of the other states in the Midwest. Smoking status. We want to find out if they're smoking cigarettes, chewing it, smelling it, snorting it. I don't care what it is. There's going to be a 25% rate surcharge in regards to smoking if they're a smoker. Income and occupation we'll get to in a little bit, and then we also want to know about other coverages that they may have in place. From an underwriting standpoint, again, this is our kind of the last 10 minutes. I want to spend a little bit of time in regards to understanding the importance of underwriting. And in regards to the first one, occupational underwriting, we do want to find out a little bit more than just a job title with our clients. In some cases, it's fairly easy. If a client's an attorney or a CPA, they're fairly easy occupations to classify. It gets a little more complicated. We have business owners, and we want to find out a little bit more about their duties and what they're doing. Also, in regards to the environments that they work in is important too. You know, we do a lot with engineers. Are they in the field? Tell me a little bit about how much time they're in the field. I mentioned owners of businesses. How much ownership do they have? How many employees do they have? It comes into play in regards to stability. The more employees they have, it certainly impacts the better occupation classifications that we have available. That determines the rates. How many hours they work, and again, that's a big reason for that is we are interested in protecting full-time employment, and again, 30 hours a week. But we do have available part-time coverage. Somebody that works between 20 and 30 hours a week, we still can cover some of those individuals. Again, those occupation classifications, the duties are important, the environment that we talked about, the income levels that they're at has a play, and also it provides all of these things enter into stability. This is just an example of some of the occupation classes that we have at the principal. So a 6A occupation class is our best occupation, most liberal, best rates, most liberal definitions. And then as we go down, 5A, 4A, 3A, the contract's still relatively the same, but the rates are going up at each one of those levels. And it's all based on claims experience. We just have a higher incidence of claims as these folks go up into these categories. 2A and A is more of a blue-collar marketplace. So, you know, the contracts become a little more pricey, a little more restrictive, if you will. But again, we have different carriers that do really well in some of these occupations. And again, Lolo will direct you in the areas that they should be looking at. Again, as I mentioned earlier, the value of that non-can contract, once we lock in that occupation class, it's going to stay that way as long as that client owns the policy, even if they move or change jobs later on. As far as underwriting is concerned, typically for many years, we would require blood, urine, financial documentation, APSs were ordered. That was typical process for applying for disability insurance. You know, what's evolved over time though is we've been able to, how do you say, live with some exposure, a certain tolerance of risk. So we have developed, in our whole industry has some simplified underwriting, which has helped a great deal in regards to moving products or these products quicker. In regards to the telephone or the simplified process, just to give you some idea how it works, if we have 8 clients within a specific age group, maybe it's 18 to 50, that's buying a specific benefit level, anything less than $6,000 a month as an example. There's no blood that's required, no urine, no APSs are ordered, no financial documentation is even required. All that they do is they do a telephone interview, and then we check the motor vehicle report, we check the medical information bureau, and they also do a script check, a prescription check for that particular client. Based on that interview and those 3 checks, we're going to make an underwriting decision. So it allows our the clients to move product a little quicker, if you will, through the underwriting process. It's been a great tool for all of us in this industry. But this is just to give you an idea. In some of these requirements just based on age or benefit amount drive some of this. As far as medical underwriting is concerned, these are some of the common concerns that we have in our business. Back claims and mental and nervous claims are probably the two most prevalent claims that we see in our business. So if you do have some clients with some history there, just make them aware that there could be an adverse underwriting decision. Just as a rule of thumb, 60% of the applications that we receive every year are approved as applied for. 40% of the time, they're coming back different. It could be a rating. We'll get into that. Riders, exclusions, declines even. Some common declines, and I'll let you kind of look at this list real quick, but chronic fatigue, cancer, stroke, all of these, if you run across somebody that has something, especially if they're calling you, might be a reason that we might be a little concerned. There are issues that, certainly our clients are contending with too, that we still may be able to make an offer on a case. And this is just some examples, especially the back, things of that nature, anxiety. And as far as our underwriters are concerned, they have the ability to utilize some of the flexibility of the plan design that we talked about earlier to help them as far as negotiating offers. Maybe they might not be able to get the benefit the client's applying for. Maybe they just reduce it a little bit, or they shorten the benefit period. They don't like the risk, but hey, we're willing to take some of that. Maybe it's a 5-year benefit as opposed to 65, or we got some back concerns, and as opposed to 90 days, I feel more comfortable with a 180-day elimination period. And again, the other tools or underwriting possibilities are, I mentioned already, is rating a policy. So we might, as an example, height and weight might be out of line. So they might have a rating as 25 or 50% on top of the policy. Or exclusions, which are common. Somebody with that existing problem with backs, a knee surgery, or something along that line where they'll exclude coverage. One of the coolest things I think about low load, and really my hat's off to these guys, is they do a great job in regards to taking care of their clients, of coming back and making sure that these clients can get reconsideration. So if we issue a policy with a back exclusion and they say we can look at this again in 2 years, low load is on it. They're reaching out to the carrier and saying, hey, we want you to relook at this thing. And not a lot of advisors do that. So it's a great service I know low load brings to the table. As far as financial underwriting is concerned, again, simplify. We don't need all the tax returns, but we still need to document the income on the application. So they're going to ask for year-to-date income along with the previous 2 years. Anytime we've got clients that are applying for larger benefit amounts, though, typically we're going to need some tax returns. First 2 pages of the 1040, corporate returns if they're filing them, joint returns, we'll still need their W-2. Sometimes we'll use an employment contract, with our young doctors that are starting their first jobs. We'll take that employment contract and use that as financial documentation. And again, we're interested in protecting their earned income. Most of the time we're asking these questions, tell me a little bit about your income history. We'd like to see what they file with the IRS. And again, for business owners, it's net income. Unearned income really comes into play whenever I run into somebody that has a large earned income. Somebody says, I'm making 800 grand a year. We're going to start asking some questions about their unearned income because it may have an impact on how much benefit we can offer, along with net worth. So if somebody has a net worth of more than $10 million, we would consider them to be self-insurable. So we would not extend coverage. It's not a good risk for us. One last thing in regards to earnings. Again, we look for patterns. If you see a trend where the guy's income goes from 100 to 120 to 140, that's a good trend for us. We like that. Good stability, good risk. We'll offer a benefit at $140,000 of income. If we see a trend going the other way, 140, 120, 100, chances are we're going to offer it at 100. We're not going to average those numbers. But if it does bounce around, we do tend to take a look at a 3-year average. Last thing I'm going to leave you with, though, is in regards to why should I buy this stuff now? And I think for many of them, I'm going to use an example with my own son, but in this particular example, I don't care when you purchase it. disability insurance. In this case, Raymond buys a policy at 35, or Raymond waits 10 years and buys it at age 45. Ultimately, when it's all said and done at the age of 65, the clients end up paying the same amount over the cumulative amount of that time frame. So all that happens is they get 10 more years of coverage for the same cost. And the point I want to make too is in regards to my son. When he was 26, I made him buy his own policy. And at first he's like, Dad, why do I need this stuff? I'm 26 years old. I don't need this. Single guy, right? He had coverage through his employer. So we supplemented his group plan. He was eligible for $3,000 a month on top of his group plan, and his premium was $617 a year. Tyler is now 31 years of age. He's married, had his first child about 2 months ago, and he's looking, obviously he's still working with the same employer. But the benefit to him, I tell him, is that you're never going to be healthier, number one, right? You're never going to be healthier than you are today. So lock in that policy, and you have the right to increase this thing down the road if with future purchase options. You're going to take on more obligations and more responsibilities as your life goes forward, and you're locking in at a lower rate, so it becomes less of a burden for you as time goes on. Again, we're never going to be younger. We're never going to be healthier. Take advantage of it, lock in those rates. That's why we want to buy this coverage now. I'm at the end of my rope on this thing. Again, I appreciate the time. If anybody has some questions, please respond in regards to the chat, box. But again, I'm just going to leave it at, hopefully there's one thing that you can take away from this. It's an important topic that we need to bring to our clients. And if we can at least give them the opportunity, it's incumbent upon us to bring up this conversation, because they don't pay attention to it. It's not something they sit around the table and talk about on the weekend. So it's important that we at least give them the opportunity to protect their income. I thank you for everything that you guys do. Appreciate the time today. Claudia, do we have any questions?
Yes, if you open up the chat box, your chat box, they should be in there.
Okay.
And we have a few more coming in.
First question is, does group long-term disability always coordinate with Social Security? I don't know of a plan that doesn't. So most of those plans do coordinate with. That's a reason why they're so as cost effective as they are, and they just offset for any benefits that are paid from Social Security. How easy is it to switch a client to after-tax premium payments on a group LTD policy? Are employers required to have this as an option? They're not required to have it as an option, number one. How easy is it to switch? I don't know if I know the answer to that question. How easy is it to switch? I think that's more of a group. I do individual disability insurance. That might be a group question that they can follow up with you on.
Yeah, we can have Kathy reach out. Oh.
We have another question here. It says, for an executive where the company pays long-term disability with a 50% benefit up to $25,000 a month, is it still possible for the executive to seek his own supplemental policy, or is there a standard cap? His base income is higher with a bonus and stock. Yeah, that's a great question. So in regards to that particular case, when we're participating with group insurance, we can participate as high as $35,000 a month. So again, we'd have to analyze in regards to his 50% of income. Did he hit the cap on 25 grand? And the other thing is, when we apply in-force coverage, their group insurance, if it's a taxable benefit, we only count 70% of that number. So again, if the guy's getting $20,000 a month from his employer that's taxable, we're going to only assume $15,000 towards our participation limit of $35,000. And we do have a formula or a table that we work off of. It's a very good question, and there's certainly opportunity to help that individual. What is the typical cost savings if you choose a longer elimination period? At 30 and 60 days, In the white collar professional marketplace, the difference could be 2 times the rate in regards to going from 30 days to 90 days. It's pretty steep. We don't see that big of a variance with some of the blue collar carriers with the guaranteed renewal rates. They're not as drastic, but 30 and 60 days. So you want to stay in that area of 91. Not so much of a difference between 90 and 180, but there's a big difference in 30 and 60 to 90. You mentioned anyone can afford a policy. If my client is on a budget, what would you adjust to reduce the cost? Ooh, again, great question. And my feeling is get as much as you can, as soon as you can. Don't worry about how long it lasts. In that case, I would try to get as much base benefit as I can. I wouldn't worry about cost of living or any of the other features. Get residual future purchase options, and then maybe even look at a 5-year benefit period. But again, the reason why I always like to stick to 65 is because our clients' situations change. And if they want to adjust their benefit in the future with a future purchase option, they don't have to worry about it. Now, they can always go through underwriting and change a 5-year benefit to 65, but they got to go through medical underwriting to do it. So again, I would say from affordability standpoint, focus on the benefit amount first and foremost, and then kind of work around that. I have a client with a sickle cell anemia, but is working full time and managing the condition. Would she be a decline? I would say she would probably be a decline. But again, it's a good option to touch base with low load because they have the ability to do prelims with our underwriters all the time. A great example why we want to ask that question. You mentioned that 60% of the policies are written as applied for and others may be modified. Is it better to wait until the client's issues are resolved before applying for coverage? No. That's a good question, but no. We want to apply and get that coverage in place. If we have the ability to get a contract and maybe it has an exclusion or a rating or something along that line, we know that's the worst case scenario. And now we can go back, as I mentioned earlier, and get reconsideration. We can apply again. But if it gets worse, we might not have any options. So that's a great question. And again, I would take advantage of, get what you can now and fight with them again in regards to a reconsideration. How many claims were the result of COVID-19 in 2020? Again, we had quite a few clients that filed for benefits because of COVID-19. Not a lot of them satisfied the elimination period, though. Again, that most of our clients have a 90-day elimination period, and they were better. One of the things, though, that we are monitoring is there's a thing called long COVID. You could probably Google it, long COVID, where some clients may have had COVID, but the symptoms continue later on. Client may be asymptomatic, but have disabling conditions for like chronic fatigue that continue to impact that client as time goes on. So that's something that our whole industry is paying attention to. With so many states legalizing marijuana, how does Principal underwrite for it? Again, if it's recreational, it could be standard issue policy. If it gets to the point where they're smoking it quite a bit, you might see smoker rates. Or if it's excessive, you're going to see a decline. So that's kind of the 3 tiers, I would tell you. Can you repeat the second reason to consider an individual coverage on top of group coverage? Taxability, reverse discrimination, I think would be the second one. Incentive compensation, and then portability are the 4 reasons why we want to address those. What happens to your individual LTD policy if you lose your job and don't get another one right away? Again, terrific question. There is language in the principal contract that addresses unemployment. So you still have coverage if you end up losing your job and you're unemployed. The definition of disability changes, though, by education, training, and experience. So it's a broader definition of disability, but you're still covered because we don't have a specific occupation that they're working in. Those are all the questions, Claudia, that I kind of ran through real quick. Hopefully we knocked out some of these.
Yeah, no, you answered all of them. Great. I want to say thank you again for joining us for our Insurance Academy Lite. We always love to have, you know, information from the source, and I can clearly say that you provided that for us. So thank you. And thank you everyone else who
Thank
joined
you.
us. If you have any other follow-up questions, there's some, I think there's space in the survey. So if there's a question that pops up afterwards. And thank you again, Bob. I will end this webinar.
Claudia,
Just,
appreciate you and Kathy's
yeah,
help too. You guys have been awesome.
yeah.
Bye-bye.
Thank you. Have a good one. Bye.
Bye.